Imagine having your retirement savings suddenly opened up to a whole new world of investment possibilities. Exciting, but also filled with potential risks. That's exactly what a recent executive order signed by President Donald Trump aims to do. Expand access to alternative investments within 401k plans. This initiative, officially titled Democratizing Access to Alternative Investments for 401k Investors, is stirring up conversation among financial professionals and investors alike. But here's where it gets controversial. Are these options truly suitable for most 401k participants? Or do they introduce unnecessary volatility and complexity into retirement planning? To unpack this, we spoke with Kathryn McCall, Vice President and Financial Advisor at CapTrust, who provided an insightful breakdown of what this executive order means and why it matters. Simply put, the order encourages employers to include non-traditional investment choices within their 401k offering. These alternative investments encompass a wide range of options, such as private equity, private credit, real estate holdings, commodities like oil and gas, and even cryptocurrencies, including Bitcoin, a highly debated asset. McCall explains that the goal here is to leverage the vast pool of retirement funds invested in 401ks to allow individuals exposure to these potentially lucrative but riskier assets. President Trump, who has openly expressed, employers play a critical role here as fiduciaries responsible for curating the investment menu available to their employees. McCall urges caution, emphasizing that adding such volatile assets can increase the employer's liability and potentially jeopardize workers' retirement security if not handled carefully. Moving beyond cryptocurrencies, McCall sheds light on private equity and private credit, categories traditionally reserved for ultra-wealthy investors. The private investment market has grown substantially in recent years, largely because fewer companies are going public. While there are approximately 4,000 publicly traded companies in the U.S., around 25 million remain private, representing a massive investment universe. However, these private market investments come with notable downsides. First, they are illiquid, meaning investors often cannot access their money immediately. It might take months or even years to exit. Additionally, these investments usually entail higher management fees compared to publicly traded funds and involve complex structures that may be difficult for the average investor to fully understand. To quote investment legend Warren Buffett, "If you don't understand the investment, you have no business being in it." This advice is especially relevant when dealing with retirement funds that represent a person's financial future. An important question arises. Why haven't alternative investments been widely available in 401k plans before? The reason goes back to regulatory frameworks and the stringent fiduciary rules under ERISA, Employee Retirement Income Security Act. Many alternative assets don't meet the criteria to be deemed suitable or in the best interest of investors under these laws because they are less regulated and more speculative than traditional investment options. This executive order opens the door to a broader debate about balancing access and risk. As alternative investments become more accessible, the responsibility rests heavily on plan sponsors, advisors, and investors to educate themselves about these choices. Could offering Bitcoin in a 401k be a visionary step toward financial innovation? Or is it a dangerous gamble with retirement security? The answer isn't clear-cut and probably varies by individual circumstances. What do you think? Should 401k plans include cutting-edge but risky assets like Bitcoin and private equity? Or is preserving steady, lower-risk options more important? Share your thoughts and join the conversation. This is a financial evolution that affects all of us.